All right, we are going live. Not sure it's going to work or not. And let's see what Restream says. Oh, it says live now. Okay. Let's go to that. Let's go to my profile, see if that's working. And let's see live today. Let's join that. That one's broken. All right. Well, edit that. No, that's not what I want. Edit. Can't edit. Okay. All right, let's check YouTube. Um, um, Let's see. Well, that one's working. Okay, so YouTube works. LinkedIn does not, but that's okay. All right, so we're going to get started here in about 45 seconds. And then we'll go over the 4 steps. And we'll save $18,179 a year without making any more sales or spending any less. That's kind of the key to the whole thing, because you can lower your taxes by getting rid of all your money. That does work. It's not really helpful then. So most people prefer to have their money and pay less tax. Kind of the key to the whole thing.
Right.
All right, so let's go to the other events page, see if that's working on LinkedIn. All right, organizing. So is this one streaming? Nope. All right, so LinkedIn is messed up, but YouTube's working, which is good enough for now. All right, so we will go ahead and get started. So welcome everybody, well, people who are watching on YouTube anyway. I will post the recording, so the LinkedIn people will have a chance to see it. But obviously, that is not the best way to go, because they won't be able to ask questions. But I will have a way to ask questions later, so that'll be at the end here. So like I was just saying, we're going to go over proven tax strategies to save $18,179, and I'll go into the exact math as to how that works. And this is all without making any more sales or spending any less. So it's using the same income that you have now and just treating things in a more optimal way. So our plan, well, you can join us on the Zoom chat, taxsherpa.com/Zoom. That should take you to the webinar page, and you should be able to join in the audience there. We are not streaming on LinkedIn, but we are streaming on YouTube. Not sure if Facebook's working. I don't feel like checking it right now. But to join us in the chat, hop in the Zoom room, taxsherpa.com/Zoom. So here's the plan. Step one, I'm going to show you what most people are doing wrong and costing themselves thousands of dollars. Step two, I'm going to show you the steps to saving $18,179 and, more importantly, getting 2 months of your life back. And over the last 6 months, I've really had this revelation that, more than the money, the time is even more critical. And we'll get into what that 2 months actually means. Step three, we'll show you your next steps. And step four, if we have time, we will do questions. I'm kind of doubting we're going to have time for questions today, but we'll give it a shot. We'll be aspirational. And if we do run out of time, I'll show you where you can actually ask those questions. All right, so part one, what are people doing wrong? So this is what 23 million people in America do. So we got John Q taxpayer here. He's got a small business of some kind. He's making 100 grand. And, that goes on what's called Schedule C, profit or loss from business. And whether you are a sole proprietor, a DBA, or an LLC, this is usually how most people file. And it's horrendous. And the reason why it's horrendous is you can see down here, taxes and credits, this 100,000 creates $17,000 worth of income tax, or well, total tax anyways, 17,781 there. So that's what most people are doing, and that's just terrible. So what they should be doing is taking that same income, structuring it in a different way, and cutting down on the amount that actually hits the bottom line for taxes. And so now we've got $59,000 worth of income, and then when that all becomes taxed, if we're talking about married, two kids, which is the same situation as we had before, it goes from owing 17,761 to getting a refund of 436. So, this scenario was actually pretty low already because we're saying they're married and we're saying there's two kids. So the two kids take $4,000 off the top, and the marriage puts them in the lower. For any given level of income, if you're married filing joint, that's going to be the lowest tax level for whatever that income is. So we're playing fair, in both situations here. So going from owing 17,761 to getting a refund of 436. And that is a swing of $18,197. So over the next few minutes, I'm going to show you how we actually achieve that. So what I want you to focus on is SDE. So if you are new to or if you've never been in the mergers and acquisition space, SDE is seller discretionary earnings. So in small businesses, we know that not all of what the seller has to work with in terms of their personal lives is captured in the tax return net profit. So SDE tries to come up with a number. It's like, okay, how much personal benefit do I end up having? And that's the number you want to focus on, not net income. And so going from owing, so if we make 100 grand, $17,000 is 17.7% of your money, right? So that's, I made 100, I paid 17.7, and that leaves me with, 82.3%. So that's equivalent to 17.7% of the year because, you spend all year working, you're doing everything that you need to. You're whatever your business is, you're doing those activities, you're reaching out to people, you're doing client work, whatever it is you have going on. You're spending 17.7% of that. If you make this 100 grand, are married and have two kids, 17.7% of that is you're working for the government. And going from that to getting a refund, that gives you back 64 days of your life. So that's 2 months that you spend working for the government, that if you do things in a better way, you are now not working for the government. So that to me is more and more critical as maybe it's just I'm getting older. I don't know, but the time involved is more critical than the money to me. And so now you have 64 days of your life back, and that's every year. That's not just right now. You have 64 days of your life back. What do you want to do with that? Maybe you want to go on vacation. Maybe you want to reinvest time into your business to grow bigger and stronger. Maybe you want to spend time with your family. Maybe you want to start a pottery class. I don't know. It doesn't even matter. It's just it's better for you to make your own decisions about what to do with that time and that money than it is to hand it over to the government. So that's a big part of my mission and our mission here at Tax Sherpa. So this is us, Tax Sherpa, taxsherpa.com. I'm Neal, the founder of Tax Sherpa. We've got on the line here, we've got Mike and Fatma and Serena, and
Hello, hello.
they're all here in support. Serena's our ops manager. If you are communicating with us most of the time, it's going to be Serena, unless it's one of your specifically assigned people, because she handles kind of all the major ins and outs and all
Yeah.
that kind of stuff. So, quick note about me. Um, I started my entrepreneurial journey in the year 2000. I can actually pinpoint the moment that I became an entrepreneur. And this was, I was, so I went to engineering school. I didn't go to school for accounting. I went to engineering school when I was interning with AMD out in Austin, Texas in the year 2000. I happened to be there during the time that the first 1 gigahertz computer processor was released. And it was a big thing at AMD because AMD beat Intel to the punch as far as, getting those chips to market. So there was huge celebrations and the stock went up and everybody was super excited. At the end of the term, I guess it was around May, we had a corporate awards ceremony. And so that we're in this auditorium and the vice president of something or other is handing out plaques, let's John got 3 patents this year. Let's give him a hand. Everybody claps. They give him a plaque. Obviously, the patents belong to the company, but that's the deal you make when you sign up. Um, and then there were a bunch of these. This lasted all morning. But I only remember the last one. So the last one was we'll call him Bob because I named everybody in my stories Bob. And Bob had a European vacation, a 2 week European vacation booked with his family and pre-approved and everything. And it came down during that crunch time. Like he didn't know ahead of time that that was going to be the time that we were launching the 1 gigahertz processor. And he cancels his vacation and comes into work to help the team during crunch time. And isn't he such a great company guy? Let's all give him a hand. Yay. Everybody's clapping. And it was right then that I realized this isn't for me. I am not gonna, be canceling my European vacation. It's planned months in advance because, the company just happened to have this product roll out during the time that we'd already agreed upon that I wouldn't be there. So that is that was my start. So, I had been going to school. I was in engineering school. That was like the beginning of my senior year. And I was like, well, that's it. I don't know what I'm gonna do, but I'm not gonna do this. So I spent the next, 10 years or so trying this, that, and the other thing. And let's call it poorly overall. And then in 2007, I started getting letters from the IRS. Just to add on to, insult to injury. So in 2007, I started getting letters and they said I owed over $1.3 million of taxes. And I was just like, there's no way. So if you haven't been through it, here's what happens. First, you get letters. And if you ignore those, then you'll get, and the number's big enough, and 1.3 million is certainly big enough. If you ignore those, then they'll start sending you certified mail where you have to sign for it in order to receive the letter. And if you ignore those, then you start getting phone calls. And I had phone calls from a woman named Joyce, and she was my revenue agent. And I talked to her once. I was like, it can't be right. And she's like, well, that's what the computer says, blah, blah, blah. And so I never talked to her again. And then they'll start garnishing things. They'll start taking money from wherever they can find it. Could be bank accounts, could be paychecks, could be boats, could be houses, could be whatever they can find. So in my case, I didn't have anything except for a paycheck. I was working, making very little money at the time as a W-2, and then the HR department got a letter from the IRS saying you have to start garnishing this employee's wages. So they started doing that, and that actually got my attention because my paycheck essentially went to zero, and I could not afford to live, pay rent, eat, that kind of stuff. So this whole process takes years. So by 2011, I ended up finding a former Wall Street tax attorney to help me out, and he was able to sort through my problems, and it took a little bit of filing time, but we got it all resolved. And in the process, I discovered this whole world of Wall Street tax planning that is pretty not well known. So, people are out there and they know that there is things or there are things that people do, like CEOs and hedge funds, they have all these loopholes and all this kind of stuff, but nobody actually knows what those things entail. And that includes the actual tax preparers out there for the most part. So I end up just happenstance falling into this world through exploring my own problems. And this particular mentor of mine, his business was growing, but he had no managerial skills. He didn't know how to run a business. So I came in and I helped him operationalize his whole business, and we tripled it over the next couple of years. And in the process, I went through a very old school kind of apprenticeship model as far as tax education. And what I didn't know until many years later was that this was not normal. So, most people in the accounting world, in the tax world, they go to school, they most will major in accounting. Maybe they take a CPA exam, maybe they don't. But it's all on, just filling out the forms essentially. So the typical experience that somebody has doing their taxes is, they go through the year. At the end of the year, so now we're in January, tax filing season is starting up. In fact, the IRS is opening next week, fingers crossed. And they go see their tax person once a year. They say, "Here's my papers." They say, "Thank you," and they put them all on the computer and they type, 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 and they say, "Here's your tax return. You owe $17,000, or you're getting a refund of $2,000, or whatever the numbers are." And that's kind of the beginning and the end of it. So that's not what I was trained to do. That's not what people do in the Wall Street world. That's not what uh, it's not it's not it's not a good plan. It's no plan, right? Because that's just reactive filing after the fact. Well, what we do with our clients is we proactively plan throughout the year in order to achieve the goals that we're aiming for. So that is kind of the difference between Wall Street tax planning and then just tax filing. So I would say it's a much more involved process, and we are bringing that level of stuff down to Main Street. So because of my years in the wilderness, trying all different kinds of businesses and succeeding at some, failing at others, you know, basically my tribe of people is all those people out there who are doing their own grind and trying to make things work. So, if you're a solopreneur, independent contractor, or a small business owner, that's who Tax Sherpa was founded to serve. And over the years, done 50,000 plus tax returns on billions worth of revenue, saving clients, over the years, hundreds of millions of dollars. And that's kind of how I developed this 4-step system. Oh, it's well, with a bonus, so there's going to be 5 steps, but 4 core steps that we're going to go through here and show you exactly how this whole thing works and how you can save the same money. And your number is going to be different. It's not going to be exactly 18,179 for you, but generally we see anywhere from 15 to 50,000 really with our clients, somewhere in that range. But the steps are the same. It's just the numbers change depending on your individual situation. All right. So without any further ado, let's jump into it. So step one, you LLC. So that's my Uncle Sam, pointing at you. So having an LLC is creates a separate entity, and separate entity is job number one for asset and tax protection. So by doing this in the right way, you reduce your risk of audit by a factor of 10. So you've heard, I'm sure, that the IRS is hiring 87,000 revenue agents. Now it looks like it's going to be less because it's negotiation between the Republicans and Democrats over the spending limits and all that kind of stuff. But it's still going to be a lot. And when they tell you that, we're only going to audit people making more than $400,000 a year, I'm telling you right now, they're lying to your face. It's probably not a surprise, but there aren't enough people making that in order to justify those numbers. So what happens is every couple of years, the IRS publishes this analysis. They call it the tax gap. So the gap is the difference between what the IRS thinks they are owed and what they actually collected. So the most recent analysis is for the years 2014 to 2016, and they're actually working on the latest version right now. They gave a preliminary report a little while ago, but that's probably about a year ago by now. But yeah, it takes them a long time to compile these reports because they have to complete audits and everything. So basically, for these years, they estimate the true total tax liability to be $3.3 trillion, and of that, they collected 2.8. So that left a gap of $400 billion. So that's the gap that they see, and they break it down by 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 filing type and by category. So and then there's non-filings, and there's underreporting, and then there's underpayment, and all these different kind of categories. The biggest one is this one right here. I know it's hard to see, but this is individual income tax, business income. That is uh, that's this guy, Schedule C, profit or loss from business on your individual income tax. So they're saying that 30% of the gap is on this form right here. It's a very simple two-page form on your tax return, but they're saying that between underreporting and non-reporting and all this kind of stuff, 30% of the money that they're owed is on these forms right here. So that is an important thing to remember. And so let's put yourself in the IRS's shoes. Okay, we've got 50,000 new agents, let's say. And some are going to be going to tech support and customer service and all that kind of stuff, but a lot of them are going to enforcement actions. So we've got 50,000 people. Where are they going to spend their efforts? Well, they're going to go where the money is. The biggest pot of money is in that one category. And the biggest line items, although in that one category, is actually car and truck expenses. And well, actually, that's the biggest one by far. I've seen crazy tax returns, because when we talk to a new client, we say send us your old tax returns, and I've seen some crazy things that other preparers have done. But yeah, so at the very least, they're going to spend 30% of their efforts on that category. And yeah, I'm sure they will go after, the 400,000 and up place. They've made statements that they're going to go after large partnerships. So like, 100 or more partners, because they can be hedge funds and those can be real estate syndications and all kinds of stuff. And I'm sure they will, but there's still 40,000 people left over that have to be doing something. And that's where they're going to be going. So by shifting into an LLC and getting that off your tax return, and it creating its own tax return, that's going to reduce your auto risk by a factor of 10. And the factor of 10, you can actually see on this chart, is in corporations versus individual. So that is job number one for audit protection. And then people ask, do I need an LLC? Do I need a corporation? Do I need a PA? It doesn't really matter for tax purposes. Occasionally, and in some states, there are issues with that depending on what you're doing. But in most cases, LLC works fine and has fewer regulatory requirements than corporations. We had a client just recently who's an architect, and in his state, he had to do a PLLC, a professional LLC, rather than just a plain LLC, which is fine. The taxes all work the same way. It's just a state compliance issue if you have one of those. So, if it applies to you, contact your licensing board or Secretary of State if you're in one of those special categories. Inkfile.com, we use a lot. They're a great service. So if you're looking for somebody to use, we recommend them. It's no commissions or anything. It's just they do good service and they will file the forms. They do it in all 50 states. Speaking of states, what about Nevada? Uh, this is the question we get a lot. Where should I put my company? And really the answer is that, these are pass-through entities. So it's going to make the most sense to do it in your home state because it's going to come home to you in your own state anyways. The only exception to that is if you're doing like an online business, then you could locate it in another jurisdiction, and it's the income's still going to come home to you, but sometimes there's privacy aspects of filing in Nevada or Wyoming or Delaware, where when you go online and you look up the company, you can see the company, but you can't see the owners. So that is one consideration in those cases that you need it. And then 92% of the time, what you're going to want to do is make an S corporation election. So for S corporations, these are small companies, 100 or fewer stockholders or shareholders, and you can only have one category of ownership. So like in a full corporation, you could have 14 different types of stock if you wanted to. Some have voting rights, some don't. Some get this share of profit, some get that. In an S corp, everybody gets the same. So and usually that's fine because these are owned by usually one person, maybe two people, and um, and the great thing about S corporations is that they do not carry self-employment tax, which is a big part of tax bills when you're filing Schedule Cs. So this is step one. Get an LLC if you don't already. elect S corp most of the time. Obviously, you should consult your advisors to make sure that is the right decision, but 92% of the time it is. And the other 8% of the time, there's special considerations where you want a partnership or you want a disregarded entity and you do want to keep a Schedule C, but it's rare. So most of the time, that's going to be the way to go. All right, so that's step one. Step two is you got to actually act like a business owner. The biggest problem that people have when it comes to both audit protection and operations and tax savings is that they are just kind of doing their thing. There's money in the bank account or there's not, and that's just kind of how it is. And then at the end of the year, they scramble to put records together, and they go to their tax guy once a year and they say, "Here's my stuff," and the tax guy says, "Okay," and puts it in the computer and it comes out however it comes out. So you got to be proactive. You got to actually act like a business owner. So I'm sure everybody knows that the big companies on the stock exchanges, they have quarterly earnings because it's always on the news. This quarter Apple reported whatever. Um, so you got to do that. There's the reason why the big companies do it is because it makes for better business. You have to do the same in your small company. That's just the unfortunate reality. Well, I don't even know if it's unfortunate. It's the reality of the situation. You gotta do the things to operate your business. And this is about working on your business and not in your business. So in your business is doing the thing of whatever you're doing. On the business is managing and streamlining operations and looking at tax efficiencies and all those kinds of things that are above the core element of doing whatever it is you do, whether you're a graphic designer or a plumber or whatever. You gotta act like an owner at least once a month, and we'll get into exactly how that works here. So to get business benefits, you have to be a business, and this is a big problem with the Schedule C filers is that they're not acting like a business. So step one of that is you got to get your books done and get them done professionally. The reason why is because A, you're doing it wrong, and B, uh, you want to be again working on your business and not working in your business. So what happens is if you are doing the books yourself, and you know, you know, we're on January 23rd, so December is finished. That closed out the whole year, and you know, people say, "Oh, okay, so I'll start doing my books," and then somebody sends an email, or you have a call with a customer, or any number of things pop up. It's like, oh, okay, I'll get to it later. And later just never comes. So, we see so many times that, people have the best of intentions to do their books and then everything else just takes priority. And the reason why it takes priority is because people are thinking of this as a cost. It costs time, it costs money. But if you do it right, this will actually be a profit center for you because it'll make you a better business owner. And the process we're going to go through here will show you how to do that. So, step two is you have to have monthly management meetings. So, it's critical to stay on top of what is happening in your business and your plans, your past plans, and how they've actualized, and your future plans going forward. So, and plus, it's a tax benefit. This gets into one of our favorite tax strategies, which is the Augusta plan. And the Augusta plan allows you to create tax-free rental it's tax-free rental income for yourself and then a deduction expense for the business. So here's how you do it. You get 1 day meeting space comps in your area. So call up the local hotels that have ballrooms, call up your country clubs, call up other places that are renting out meeting space, and then find out whatever the rate is in your area. Changes, different areas have different rates. New York City is going to be different than Des Moines, Iowa. So you have to get actual comparable listings, and then you create a rental agreement between yourself and your company. And this only works if you have a separate company. So back to step number one, you got to have a separate entity. Uh, so you create a rental agreement, and this is the code section 280A, which is the primary section, and then there's some supporting court cases and all that kind of stuff. And then you have a meeting. Now, the problem with meetings is that people say, well, do I have to keep minutes? And how do I do that? And all that kind of stuff. And they start to panic and say, well, we got you. Your minutes panic is solved. And I'm going to walk you through it. So these are going to be baby steps. So your first item of your meeting is you're going to review your books, and you're going to review month over month. So we just closed, we're just finishing January, or so we're in January, we just finished December. So you're going to compare December to November and see what was going on. You're going to compare quarter over quarter. So we just closed Q4. You're going to compare Q4 to Q3 and see the comparisons of things that are going on. And then you're going to go year over year. So with December just being closed, we have the full year of 2023 to look at. We're going to compare that to the full year of 2022. If we're in July, then we have January through June. We would look at January through June of this year compared to January through June of last year. So that's what I mean by year over year. It's year to date of this year compared to year to date of the previous year. And you're going to look at different items. So you're going to look at revenue. That's obviously number one. The money coming in the door is the limiting factor to everything. So that number is critical. Is it going up on a month over month basis? Is it going up on a month or a quarter over quarter basis or a year over year basis? Is it going down? Is it going sideways? And more importantly, why? So, you know, so here at Tax Sherpa, we had a good December because we put into place a special promotion where people could, either typically we'll create a package for a customer or client and we'll spread it out over 12 months. But we did a year-end promotion and we said, okay, if you want to pay up front, we'll give you a discount. And a lot of people took us up on that. So we got a lot of cash flow in December, and then January is going to be less. So I'll be looking at that in February. But so why did these things happen? Did I try a new marketing thing and it failed? Did I try to go to a convention and got 10 new pieces of business? So explaining to yourself why these things happened is critical to this whole process. Item two, large expenses. So, usually I'll say over $1,000 is a large expense. Your business might be different. It might be $5,000 in your business. And if you have inventory, you want to look at that number because that's going to be a large expense. So, but whatever the case is for your business, you want to look at those large expenses and ask yourself, was this a one-time expense last month? Was it a recurring expense? Can it be done better, cheaper, more efficiently? And should go through item by item of those large expenses and answering these questions to each of them. And when I say answer, I mean write it down. I just want to be clear about that. Write it down. That is the key thing to the whole process. That's the writing is what creates the minutes that people are so worried about. Item three is all other expenses. So everything that's not a large expense. Are they up? Are they down? Are they sideways on a month over month basis, a quarter over quarter basis, and a year over year basis? And again, why? So what is the rationale? Tried some more email. Didn't work. I found a better email provider. This guy went down. I had to switch servers and, go to this other place that increased my expense. Write out the story of what happened and why the expenses are doing the things that they are doing. So item four is reimbursements and rental. So for reimbursements, what we're talking about is the business use of your personal stuff. So if you have a home office, which you probably do, we can get into a little bit about some of the qualifications of home office. But if you do, then you have a percentage of your rent or mortgage or your taxes or your insurance or your utilities. If you have business use of your car, all those kind of stuff, business use of travel, those kind of things, you total up your bills, you apply the appropriate percentages, whatever they are, and then you take reimbursements. So reimbursements are not income. I'll say that again. Reimbursements are not income. They are making you whole for an expense you already incurred. So it's not new money to you. It's just filling up the hole. And you're going to pay yourself an appropriate rental fee per the agreement that we found from the comparable sales or comparable listings. And item five is review your plan from last month. So obviously this is only applies for the second meeting and onwards. For the first one, you don't have a plan in place, probably. So, but assuming you're in the second month of doing this, then you want to look at last month and you say, okay, what was my plan a month ago? And how did that work out? Am I above? Did I meet my goals? Am I above meeting my goals? Am I below meeting my goals? Why? And again, write it down. And then item six is you're going to create a plan for the next month and the next quarter. So, okay, now that we've seen what happened, we have observed history, we saw what worked, we saw what didn't work. what's our plan going forward? And here's the whole thing: improve on what is working and reduce what is not working. It's that simple. Okay. So I know, people like to get all tangled up in strategy and everything, but really that's the core of it. Improve what is working and do more of that. Do less of what's not working. And in order to make that decision, you have to know what's going on. That's what the whole review is for. So once you know what's going on, you can make an analysis and you can look at your business and you can say, oh, I I tried cold calling on 10 businesses and I got seven of them, and that increased my profits. Obviously, that worked. Let's do more of that. Or, I keep going back to this email thing. So I tried emailing and it didn't work. So I should cut back on that. You know, so accentuate the positive, eliminate the negative, as I think it was Bobby Farron who said. And if you do that, then your business will be better. So, over time, this effect compounds over and over and over again. You'll be more and more fine tuned as you go going along. And I'll let you in on a weird secret of human psychology that even if you didn't make a plan, and even if you didn't analyze your plans from last time, so items 5 and item 6 here, if you even if you just skip those and you just had the numbers and you looked at them every month, then that alone will activate your brain consciously or subconsciously, and you will start doing better things. So your business will improve. So that is the key to the whole thing. That's what makes your business better and better and better, rather than coasting along or slowly dwindling down into nothing. You got to do it. And in doing so, you also get yourself a tax break. So, win-win. And there's a second tax break with reimbursement. So win-win-win. All right. So this is how you have your meeting. And this is what creates an actual meeting that's justifiable. And we incorporate all the tax strategy around it. And you make more money, you pay less in tax. So that's a big part of what we do. All right. So that's step number 2 is acting like a business owner. You got to do the things. All right. Third one here. This is not going to apply to everybody, but it will apply to a lot of people. So hire your kids. 8 to 17-year-olds have major tax benefits. They got to be at least 8 because court rulings have ruled that they have to be 8 to be able to do anything really functional. 17, once they turn 18, the rules change and they're not as good as they were as far as tax write-offs anyway. Um, so they have to do actual work. So I've got a 9-year-old. My 9-year-old does office admin type stuff. She opens my mail, she scans it, and she labels the stuff. And when I looked around at my local market, did job searches for office admin stuff. It basically is a $15 to $20 an hour job. So that's what my market pays, and that's what I pay her. So they got to do actual work. You got to document it. You got to keep timesheets. You have to have job descriptions and all that kind of stuff. Track time. That's part of the documentation. My favorite job, especially for the teenagers, is social media research. So whatever your job is, you probably need a social media presence. And whatever industry you're in, there are other people with social media presences in that same industry. So have your kid run your social media as far as posting and campaigns and responding to people and all that kind of stuff, and research your competition. Now that is a job that pays actually pretty well all across the country. And it is actually a benefit to your business. And they're on their phones anyway, and they're better at it than you are anyway. So let's take advantage of that and and put them on the payroll. Now there are some caveats with that we'll get into in just a second. But more than the tax benefits, and we'll get into the tax benefits here, but more than tax benefits, the money lessons I think are the most important thing. So when my kid came to me and she said that she found a pair of rollerblades on Amazon that she wants to buy. They're $39.99, and she had like 36 something, and she only needs like $3 more. And I said, well, let's learn about sales tax. So it says $39.99 here, but when all is said and done, it's actually 43, whatever it was. And she's like, what's that? It's like, well, there's this thing called sales tax. And it's added on to the price, and that goes to the government, and explaining all that whole thing. And she got a little bit depressed. But because she was further away from her goal than she thought she was. But these are real life lessons. And all parents are spending giant amounts of money on their kids, regardless. And so when you pay them and they have their own money, you buy the same stuff, but you just use their money and make them spend it. And you will be amazed at how economical and frugal a 12-year-old becomes when it's their money that they have to spend for the thing that they want, for the new shoes or for the movie ticket or whatever it is. So, by starting those lessons early, you start to convey that information in a age appropriate way because the things that they're buying are appropriate for their age, right? So it's automatically scaling to what they have in their lives, and that works fantastically well. So kids pay for their own stuff, which is nice. And as a bonus, once they have earned income, they are IRA eligible, meaning that they could start an IRA, could be a Roth, could be traditional, and they could put in $7,000 this year. So when you look at the math of personal finance and you're looking at retirement savings and all this kind of stuff, if you have, most people start saving for retirement around 35. I mean, they're eligible to earlier, obviously, but most people don't in their 20s. They just don't take it seriously. They turn 30s, like, oh, it's starting to settle down. 35 is like, wow, time is passing. So, better get started saving for retirement. And so that's when people kind of get serious. So from 35 to 65, you have about a 30-year time horizon as far as your investment portfolio goes. If you back that up to 15, now you've got 20 extra years of investment growth that can be on your behalf. And just the way that compounds out over time is just tremendous. So the earlier you can do that, the more retirement savings you can have, and the much more efficient you can be in your retirement planning. So, but you need earned income to do it. So let's give them a job and give them earned income so that they can do all these things. And the ownership structure does need to be different. It can't be an S corporation. So if you have an S corporation, you do need to set up another entity for it. And it just gets into how the payroll exemptions work. So the way this whole thing works is that if you have either a sole prop or a partnership where the partnership is owned by both parents, then the wages paid to direct children between the ages of 8 and 17 are exempt from Social Security tax, are exempt from Medicare tax, are exempt from unemployment tax, and if you pay them less than this year 13,800, then they are exempt from income tax. So like 0,000. So whatever you pay them, as long as it's under that 13,800 number, then it's totally tax free. And you could actually go above that and then make a $7,000 IRA contribution. So you could do like 20,800, contribute 7,000 to the IRA, then that brings you down to 13,800, and it's tax free. So that is a potential 20 grand write off per kid in that range. So it's a good little savings. So if your average rate between state and federal is 25%, let's say, if you pay your kid 20 grand, that's $5,000 in your pocket that's saved. And now your kid is set up for life in an IRA, and you're teaching them money lessons so they don't blow everything when they go off on their own, get into, crazy debt and all that kind of stuff. It's not that I have personal experience with that. And so it's a win-win all around. And they're doing something for your business. So that's even better. All right, step 4, salary optimization. So this is what comes last. And it's because salary optimization is affected by the net profit. So net profit means after expenses. So all these other things that we've expensed before, the meetings and the reimbursements and paying the kids and all that kind of stuff, that all comes out the top. And so if we were at 100, now we're down to, pick a number, 60. And from there, then we start looking at salary, because you do need to pay yourself a salary. It is one of the requirements of an S corporation. They have to pay yourself a reasonable compensation. Reasonable is not defined anywhere. It depends on facts and circumstances. And you want to start asking yourself, do I want to contribute to my own retirement plan, or would I be better off holding or managing the money myself in a taxed way? There's pros and cons to both. And it's definitely a discussion we have with clients. We talked with one yesterday, and we were talking about, it's like, well, if you put 40 grand over here, it'll save you 10 grand over there, and is that worth it, and all that kind of stuff. So those are decisions you have to think about. There's different flavors: 401k, SEPs, QRPs, even more than that. Reasonable compensation, I just mentioned. So as far as calculating reasonable compensation, So uh, the rules are complex. So you have to look at what you're actually doing in a week. So when you are doing your business, let's say you're a graphic designer. So some portion of your time will be doing graphic design, right? So you get a client, you have a project, doing the thing. That's time spent as a graphic designer. If you look in your market, you'll find a rate for graphic designers of, entry, intermediate, or advanced levels. And that's that's part of what you would look at for reasonable compensation. But that's not the only thing you do. You also are doing marketing. You're also doing advertising. You're also doing customer support. You're also doing admin work. So what you want to do is actually track your hours throughout a week and then segregate those activities and figure out, okay, I'm spending so many hours doing this thing, which has a rate of $15 an hour, so many things doing that, which has a rate of $22 an hour, so many things doing the other thing, which has a rate of $30 an hour, and you figure out what the average over all of those is, and then that is a way to calculate what's reasonable for your jobs, because it's not just one job, for your jobs, for your market, for that time. And that's a great way to come up with a reasonable compensation. And the first money that you take out of an S corporation has to be go towards payroll, towards reasonable compensation first, and then after that you get profits. And then the difference between the two is two things. So one is payroll tax. So on your reasonable compensation portion, you're going to be paying 15.3% of Social Security, Medicare, just like if you're an employee with somebody else. And on the profits, you don't. So that's a big difference. And because of that differential, the IRS wants to make sure that you are paying yourself, a reasonable amount. On top of that, the profit portion factors into what's called the qualified business income deduction. So this was one of the big revolutions of the Trump tax reform, where the business profits carry an up to 20% break on the income taxes. So if you have $100,000 worth of profits coming through, then you're only going to be paying tax on 80 of it, and that's huge, right? So that's just 20% off the top, just gone. And taxes are on brackets, right? So as you make more, the percentage goes up. So that 20 you take off the top always is at the highest tax rate of whatever bracket you're in. So that can be really beneficial, especially as you get into higher and higher amounts. And then as you make more, then the qualifications become trickier. So if you're under a threshold and it depends on your filing status, whether you're single, head of household, married filing separate, or married filing joint. If you're under a threshold, then you get the flat 20%. If you're over the threshold, then there's becomes a test between 20% of just the profits and 50% of the wages, or a percentage of the assets if you're in real estate, basically. So real estate aside, that's not too terribly common. Mostly it's the 50% wages versus 20% profit. And, optimizing those to make sure they're in balance and justifiable under a reasonable compensation test is a lot of work. But it's huge tax savings. I mean, just enormous. Um, and we'll get into the math of how it worked for our John Q taxpayer here in just a second here. But the more you make, the more important it becomes. So, here's qualified business income deductions was the next element. So, how do we put it all together? And here's how it works. We had John Cube taxpayer making 100 grand. So that part's the same. So with meetings rentals and reimbursements, we got about $40,000 worth of stuff. So this is money that was already being spent. We're just recharacterizing it. And then so of the remainder, we had about 60 grand. We are recharacterizing a portion of that into salary and recharacterizing a portion of that into pass-through profit. The QBI deduction is an extra bonus on top with the pass-through profit portion. So our new adjusted gross income after the QBI is 53.1. Okay. And depending on your filing status, whether you are married or head of household or single, you get different amounts of standard deduction. So these days, standard deduction is what most people take. It's since the changes with the Tax Cut and Jobs Act, it's very hard to take itemized deductions with mortgages and medical expenses and property taxes and that kind of thing. It's just the numbers are so high in the standard now, and the state and local taxes are limited to 10,000. So most people end up with standard deduction. So that 53.1 turns into, if you're married filing joint, 25.4, or if you're single, 39,250, or if you're head of household, 32.3. And that is how we knock down the income from 100 down to 53, and your taxes drop like a rock. So that is the putting it all together piece of this. So I hope that all makes sense. Obviously, there's a lot of details in here. So what are your next steps? And we have a special situation going on right now. So this week, the 23rd of January, this is the last time this slide will be up. And we have a LinkedIn group that is, it's free to join. We call it Tactical Advice Explored. That was my great brainstorm of TAX. And the recordings of this will be posted in there. Just before the webinar tonight, I put in the blog post I put in on the beneficial ownership information report, which is a new thing for 2024. It's not a tax item, but we get a lot of questions about it. We can share ideas. I talked to somebody from the group on Monday, and we came up with a plan. We're going to save them $30,000 from last year. So it's valuable stuff. So you can go to taxsherpa.com/group, and that'll take you there. You can join there. And the reason this is the last time you're going to see this is because we're actually going to be launching a new product where part of it is going to be a group coaching session. And what we're going to do is, we go back to the meeting minutes, doing all this stuff, all these steps. Let's go back to the beginning, I guess. That's item 4, and this thing gets long. So, we have the review of the books, right? So what's going to happen is once a month, I'm going to get on a call with everybody just on Zoom, and we're going to go through, we're pick somebody out of the audience, and we're going to go through step by step, doing the thing, going through all the comparisons and looking at your books and identifying large expenses and diving into your plans. So we're going to be doing this, as a group, and that's going to be inside of a private Facebook group. And you will need to pay a little bit. It's not going to be a lot. It's kind of, I have my own business coaches, and I was telling him about my plans here. And he's like, well, that should be $300 a month. I was like, it's not going to be $300 a month. It's going to be like 100 for a year or something. I haven't quite finalized that, but we are planning to launch that here very shortly. So everybody who's already in the tax group, Tactical Advice Explored, is getting that as a freebie. So just be aware of that. This is the last time anybody's going to see this particular slide. So we have maybe, I don't know, 5 minutes left. So I guess we'll try to take a couple of questions, but it's okay. It's okay. I already have all the answers to your questions. And you could join us on the Zoom. Well, I mean, at this point, we've only got a couple minutes, but the answer to every one of your questions is it depends. And this is the thing, I started off just finding myself saying this a lot, and it kind of turned into a joke, but it's really true. It does depend. And it depends on your facts and circumstances. So, and what I mean by that is that, and this is the language that is used in the code, is that what is true for you is not necessarily true for somebody else, because your situation is different than their situation. So let's say $100 shows up in your bank account, and what is that? Is that income? Maybe. It depends, right? Depends on what it's for. It depends on the intent behind it. So just the fact that a number shows up in a place does not mean you know how to treat it. And this is actually a big part of why people do bookkeeping wrong. It's because they don't understand the difference between profit and loss items and balance sheet items and accruals and cash and all this kind of stuff. Because they don't understand the intention behind things. So $100 shows up at your bank account. Maybe it's income. Okay. Maybe it's your buddy sending you $100 to cover, dinner last night. Maybe it's a gift from your grandma. Maybe it's a loan. So all of these different things are treated differently, even though it's the same $100. All right. So I will tell you one of my favorite examples of how it depends. So normally, cosmetic surgery, not deductible. It's elective. It's for your own choice. If so the most common cosmetic surgery that I get asked about is breast enlargement, and lots of people do it. Great, happy for you. Not deductible, unless unless So there are two situations where it is deductible. So one is if you are doing a reconstruction after an accident or a surgery or something, that is a restoration of function. So that is a medically necessary operation. And so that becomes deductible because it is required as opposed to elective cosmetic, even though it's the same surgery, even it's the same thing. So that is deductible as a medical expense. And then but maybe we could get into how we deduct medical expenses through business rather than through itemized deductions. And yeah, there's stuff to do there. Uh, Second way it gets deductible. This actually went to court and won in tax court. Was that there was an exotic dancer who got a
Oh.
breast enlargement and she deducted it on her taxes, ended up getting audited, and she fought it. And she said, "No, this is for my business. This is a necessary and ordinary expense," which is Section 162. Um, Not 162, 126. I'm forgetting the numbers off the top of my head. But so she went to court and she was able to demonstrate that it actually improved her income, in her line of work. And so for her, it was a necessary and ordinary business expense in the pursuit of more income, and so the deduction was allowed. Not allowed for millions of other people, is allowed for her and other people in her line of work because of those facts and circumstances. So that's my favorite example of the differences. Even though everything else is the same, the operation is the same, the costs are the same, everything's the same. It's just the intention behind it changes the facts and the circumstances and makes one deductible and one not. That's just how it is. That's life. So, in the 2 minutes we have remaining, Serena, do we have any questions? I don't know if we
Oh,
have
yes.
any.
We have some questions.
Okay.
uh,
hit me
so,
hit
um,
me with one.
okay, one. Okay, what is the difference in a S corp versus a C corp when it comes to tax planning and strategy use?
Well, for tax planning strategies, a lot. So S corporation is a flow through, meaning that whatever its net profit is on the end. Actually, let me go back to this slide here. And you could ask questions in the group, what if we don't have time for it now.
Mhm.
So S corporation is a flow through. It files its own tax return. At the bottom is a number, net profit, and that net profit gets split amongst however many owners it has, and everybody receives their share of the profit, and that goes into their personal tax return under Schedule E2, and just goes along with whatever other income they have, and has QBI implications and all this kind of stuff. So that's an S corporation. It's a flow through. That's the key element. And the individual is going to pay whatever the individual's tax rate is based on the total situation, including the S corp. C corp files its own tax return, does not flow through. It pays its own way. So the C corporations can pay 21% federal plus whatever state, and you don't get graduated rates. And also there's no QBI because there's no income flow through. So so with C corporations, a lot of times that's beneficial. Well, not a lot of times. Some of the times it's beneficial, uh, and it depends on the situation and what your plans are. So major advantages to C corp is that if you're a tech company and you plan to sell after 5 years, then there's what's called a Section 1202 provision, where if you sell the stock of a startup that you founded, then you can get up to $10 million tax free. It's got to be a C corp. You got to wait for at least 5 years from the start. So that's a huge incentive. So that's to engender the development of big companies essentially. If you're raising funds from outside investors, almost always going to be a C corp, just because it's cleaner and that's just the preferred method of dealing with it. Because if everybody ends up with 47 K1s coming from an S corp, it just gets to be a nightmare. So by and large, anytime you're looking for big business, you're going to be a C corp. Every stock that's traded on the stock market, those are all C corps, and the reason is because they don't intermingle in this way. Now, getting your money out of a C corp is another issue. You could have either a salary or a dividend, and dividends, can be qualified or unqualified, and it gets complex from there. But yeah, that's the basic distinction. S corporation is a flow through. C corporation is a standalone. And C corporation has a flat rate, 21%. S corporation rates depends on QBI, depends on your individual rate, depends on what else you have going on your individual tax return. So that's kind of the basic idea. And with that, we are out of time. So I want to thank everybody for coming. Go ahead and go to taxribbon.com/group if you want your freebies, because that's going away here shortly. I will say next week, we're not going to have a live event because I'm going to be at a doctor's appointment. So we will be back on, what's the week after that? I think that's the 6th. Yes. February 6th will be the next one. And that will be an office hours Q&A where, people can just ask whatever questions they like. And we will get into it there. So thanks, everybody. And we'll see you next time.
Yeah. See you next time.